Good morning, it's Steve O'Hare from Pia First Limited. Today we're talking about commodities and equities medium-term outlooks for the next couple of weeks. I run a business, Pia First Limited, with Ian Coleman, my business partner, and Ian concentrates mainly on the FX products, and I concentrate on commodities, equities, and a little bit of fixed income. So we normally provide day trade ideas, which are normally initiated in the mornings and run for a period of 8 to 10 hours. And but also on the back of that, we also do medium-term outlooks via our website, piafirst.co.uk. And we're doing this presentation for FX Street for the next couple of weeks. Let me just cancel that. So yeah, well, I'll first of all, I'll give you a little bit of background on me. I've been trading for just under 30 years. Started on the commodity markets in the Baltic Exchange, moved on to the financial markets on the life floor, and then went to screen-based trading in the early 2000s, and also in the last 3 or 4 years have been working for Pia First Limited, which provides trade ideas on a daily basis for individuals, exchanges, traders, banks, etc. So I'll run through today. I'll go through the commodities. I'm going to go through oil, gold, silver. Others, you know, that people want me to analyse, I'm happy to do so. And we'll pick up on a few equities towards the latter end of the webinar. We did concentrate, focus completely on equities a couple of weeks ago, so I'll lend more time now to commodities. And we can go from there. So I'll share my screen with you. If anyone has any issues with what I'm saying or any questions on what I'm analysing, feel free to type into the chat, let me know. And I'll try and make this webinar as interactive as possible. So don't think that any question you ask would be classified as a stupid question. I never do that. All questions are relevant. And sometimes the stupid sounding questions can save you a lot of time, effort, and money if you do actually ask them instead of bottling them up. So don't be afraid to ask questions as we go along throughout the webinar. If I can answer the questions there and then, I will. If not, I'll leave them until the end and then go through them then. So commodity markets we're looking at. The dollar index and dollar strength, dollar weakness has a big relevance on the main commodity markets as they're priced in dollars. So we have oil is mainly traded in US dollars. We have gold, obviously the main focus again US dollars, and silver. So whatever is happening in the dollar can influence the prices of commodity markets naturally. So what I'll do initially, when I'll try to form the basis of my medium-term judgment, I'll look at the dollar index and try and formulate an opinion on what the medium-term trend is in the dollar index and break it down to different time frames. So to get the longer-term trend, we'll look at a monthly chart in dollar index. I've pre-populated some of these charts with Fibonacci levels, which may not mean a lot to newcomers to the trading world, but I'll go over them, do a brief explanation on some of them, and as I say, if you have any questions, please feel free to put it on the chat and I'll pick it up. So we look at the dollar index going back to 2000. So this is a 15-year chart, weekly price action, and we can see basically where the levels over history have been supportive or restrictive, and we could then formulate our longer-term trade idea, medium-term trade ideas. So we can see previous lines of resistance, previous lines of support, and the major trend down from 2000 to 2008. The 2008 reaction in the dollar, in the financial markets across the world, obviously there was a huge impact on risk. This led to a bull run in the dollar 2008, 2009. The market retraced a couple of times, but found buying support over the next few years. And in 2014, saw the big breakout above 85 resistance in this dollar index. Now, since then, prices have carried on upwards and have continued strength into the end of this year. Even this monthly chart shows what is known as a Marabuzzo candle. Now, a Marabuzzo candle is a very strong bullish candle, and it signifies a one-way drive in the market. So, as we can see, the November open was around about 96.82. The low was 96.71, so very, very small tail on here, with a strong drive higher then up to today's high. So the last day of the month today is at 136. So that's a Marabuzzo candle. So we can basically break this down. Also, there is a chart formation which jumps out at me and signals a bullish flag. Now, what I'm doing, although I'm drawing a downtrend line here, this is like support, and this is the flag. So I can finish off the flag formation by drawing the pole, and this gives us an indication of a flag pole. We can see the shape of it here. Let me just take away the Fibonacci lines, which are maybe clouding it a little bit. So this is obviously a long-term formation because it's evolved over 18 months. So here we go back to May 2014 to now November, and we're seeing a break of the top of the flag. The good thing about these formations is they can give you a projected target, and we can get that projected target by taking the length of the pole and adding it to the bottom of the flag where the prices have reacted from, and that will give us a target of 114.30. Although the target looks like it's going to come in around May 2016, it's not necessarily a timing indicator. So, but it does give you a good target of where dollar index is likely to go over the longer term. We can drag the chart back, and then we can apply it to the previous resistances. And we can see there's obviously a good resistance where sellers overcame buyers, and that's above at 120. So these are the target here, resistance above here. And we can also break it down and take this previous swing low 2008 to the high in 2009, which was obviously a major move in the markets, and apply a Fibonacci extension from there. Hang on 1 second. Let me just, yes, get the right thing up. That shows the 161.8% extension is at 102.21, not far away. We'll also go to the 261.8, and again that comes in around about 120 on this chart. So longer term we're looking higher, we're looking for a drive higher, and on a longer term basis we'd be looking to buy above this, around about these levels, because the close is today and we're looking to close above this flag. Stop on this, you'd be looking at a break of the 92.52 low there. So risk reward is about 2 to 1. Now we want to break these down into daily charts to get more of an idea of the medium-term picture. I use Ichimoku Cloud. It's a great visual indicator, offers forward-looking support and resistance, and has a number of timing entry signals which you can use. So you can actually build a trading system just around Ichimoku Cloud, although there's lots of reasons why you should look at just more than one indicator when you are building a trading system. But we can see from here, back in October, we broke above the daily Ichimoku Cloud, which was, and this is the flag which we've drawn in a similar fashion on the monthly chart. So the close above here indicated we're going higher again. Obviously, this has happened in a very short period of time, so there would be no surprise in any retracements or pullbacks. And on this basis, from a medium-term perspective, we'd be looking to buy any pullbacks to around about the 97.50, 98 level. And that would allow then the market to neutralize and then offer a further leg higher. Even shorter term, if you look at the 4-hour charts, we can see this is extended higher. So you're going to get resistance coming up around about the 150 level. And again, on a more shorter term basis, on the 4-hour chart, you'll be looking to buy into any dips around about 99.50 with a decent stop below the 99, the figure level. So on the basis of that, the dollar index is looking to go higher. If we hop straight across to gold, and if I bring in my weekly charts, again, which is already pre-populated, gold will reflect the dollar back in this sort of fashion. We can get the dollar index onto here. You can see how gold correlates with the dollar, especially recently. So with the dollar breaking higher, gold price moving lower. Gold is slightly ahead of the dollar over recent times. So this is having the negative move, and where the dollar is backing this move up. Obviously, gold will move for plenty of its own reasons, and the dollar is just one of them. So we're seeing a big move, a big commodity move over the last year or so, where prices have been hit quite hard. We're seeing levels that haven't been seen since 2010 in gold, especially. And so far this year in gold, we've been calling it pretty well, looking to sell into these rallies. I'll have to strip it again. I'll strip away these charts, or these lines, to give you a little bit of a picture of how we come to this scenario. So gold, since the break of these lows, 1570, let me just draw a line in there so I can pick it out here. 1522 was broken back in 2013, aggressively, closed well below it. From there, prices haven't recovered. Now, from here, they're looking to form an ending wedge formation, which, although it's downward trending, it is a bullish chart formation and will be confirmed with a break of the top trend line. But there's no indication that this is even close. So we remain bearish on our outlook in gold. We've been looking at Fibonacci lines on gold for a long time now, as this corrective move lower has continued. 1155 was a long-term target and support level. Prices reacted off here both last year and this year, and eventually broke down into the third quarter. And again, once we've broken through there, price action has continued to be pressured. So rallies are continued to get sold into. I'll take this down to the daily chart to get a closer look at things. And you can see with this downward trend line, capped prices, and we had a spike through this in October, early October. We saw a spike higher, but prices didn't manage to get above the resistance around the 1190, 1210 level. So you saw plenty of two-way traffic around here. Prices stayed here a long time, showing it's an important level. The spike back up here failed to breach the resistance and has continued to move lower. And this move lower has accelerated and made new lows on Friday, and it sits around the lows as we speak today. So it's not far off the 1053 low. So we remain bearish on this. Now, how do we get a trade idea from this? We have to break it down to shorter time frames, and we bring in our moving average, we bring in our intermarket cloud, and we look at a 4-hour chart on this. And the 4-hour cloud has shown capped prices once, twice, 3 times, and now we've had the extension lower. So we'd continue to look to sell into strength in gold until we probably saw a break of 11,100. Currently trading at 1055. And again, so we were looking to be selling in front of these Ichimoku cloud resistance, 1075 to 1080, stop above at 1100. And we'll be looking to target, we'll bring up a Fibonacci extension. A shorter term one would be here, 1045. And obviously we've got the psychological level at 1100, which is on everyone's lips at the moment. So plenty of reason to maintain a short outlook on this. But I'll bring it down to a more shorter term time frame, just to, well, that's the wrong chart. Just to give us an idea of maybe what we'll see in the very short term. And we're getting this, again, it's like a bearish pennant. So a break here is looking again at the 1045 level, 1043, 1044. So obviously we look at the MACDs, where you'll find this when prices move sideways, momentum is stalling, and the trigger line around about the levels we see now, it shows that there's potentially a move is going to happen. So we would, on a shorter term basis, we continue to look to set shorts. Medium term, we're looking to set shorts. Targets 1044 and $1,000 an ounce. So that's gold. Now we'll have a little look. Any questions on gold? If you have any questions, pop them into the chat and I'll answer them. If not, I'll move swiftly on to oil. Oil, this is a weekly chart for oil going back to the same area, 2008. We saw the big sell-off from just under $150 all the way down to 33 in a very, very short period of time. The corrective move higher peaked around $1 to $14, and there was a long period of sideways congestion. Strip out these fib lines, they can be very distracting. Until we eventually saw, just as a reminder, this chart is a line chart, so it's not the normal usual charts intraday traders will look at. It's more of a longer term chart and has benefits because it ignores spikes in both high and low spikes, and gives you the most important figure on a long-term chart, which is the closing price. The closing price obviously is a signal of where both buyers and sellers are content with the value on a daily basis. So the market may move up and down or even sideways, but at the end of the day, the closing price should give you a good indication where buyers and sellers are all happy for it to close. So we saw this break lower in 2014, and prices got to the $45 area before reacting higher to around about $60. I'll bring it down to the daily chart, and again, it's the sell-off spiked through. Prices stalled around this $45 area, and we seesawed and then broke lower again. And this 50 area is quite a pivotal level. We remained bearish while below $50. Targets, we're looking at levels around about $32, which wouldn't go far amiss. Obviously, in the news recently, there's plenty of people talking about $20 barrel, $20 oil. This chart indicates Fibonacci projections of $31, which is the level we're looking for, and the 161.8 is at $23, so not far away from the buzzy number $20. Again, we'll bring on in a few oscillators to give us an indication of the momentum of this sell-off, and also to confirm that we are below the cloud resistance. So on a daily basis, we're below the cloud, which sits at 4430 to 4640. So, as I say, below $50, we're bearish. Just show you this chart formation here. This is a candlestick formation, shooting star. Also, with its bullish candle prior to the shooting star and the bearish candle afterwards, it's called an evening star formation, or it's similar to an evening star formation, not an exact one, but very similar. And in terms of trading and analysis, similar things tend to work. This has led to the drive lower, and you can see this like correction as being in 3 waves. Now we've found support just below $40, and we need to see a break of this level before we consider a revisit or retest of the $38 low of August and our projected target lower to $31. So on a medium-term basis, we're looking to sell this around about $45 to $47. The stop would be above $50. Our target would be short-term target would be $38, but our target is $31 on this trade. The thing with oil, WTI light sweet crude oil we analyse. The only issue, obviously, it's a futures contract. So we look to try and place trades on continuation CFDs or such like spread bets, whatever. There's obviously the more information and the more price points you have, the better your charts will be, as they will contain a lot more detail. This morning we've seen a spike higher. I'm pretty sure that we were looking to sell into rallies this morning. Let me try and yes, I'll try and bring up this was our trade idea from this morning. Let me try and bring it to you. So this is our trade idea from this morning. This is our website, and we were looking to sell it 42.25 this morning. Stop on this trade was 42.75. Maybe you can, hopefully you can see both of these. So we got a spike high to 42.34, setting the shorts, and it's just come back on side. This is as I say, this is a short-term day trade we're looking at the moment, and we look at targeting 41.25 just in front of support of 41.15 and the 39.85 support. So let me just flip back to the charts. There we go, we're back on the charts. So that's oil, that's what we're looking at. Any questions on oil? Okay, then we'll move on and move on to silver. Again, silver is dominated by the dollar index or dollar value. It's priced in dollars. You can get all these commodities like gold and silver priced in local currencies, but generally the majority of the time they're related to the dollars and therefore affected by dollar move. We're seeing a similar story in silver to gold, where we have support on the short-term basis and rallies being sold into. So over the course of this year, we've had 3 decent up moves, and they've all been sold into and leaving us with I'll just switch this to a daily chart so I don't have to redraw the line. Leaving us with a decent line in the sand, if you were, that we remain bearish in silver. Now, we remain bearish in silver, and as long as this October high remains in place, a breach of $16.33 or maybe $16.50 would question our motives to remain short, because we're seeing a similar sort of pattern to this ending wedge formation. So we're getting towards the bottom of here. I'll bring in the cloud again, which will give us a good idea of future resistance. It will show us that we're trading nicely below the cloud resistance, and we have this downward trending supportive line, which will be, obviously we look at trend lines, and we normally like to see at least 3 hits on that trend line. If there's not 3 hits, then officially it's not a trend line until it has that 3rd hit. So we see the point 1 is hit 1, point 2 hit 2, and we're looking for the 3rd point to hit. Now the dip down to 1388, we class that as 1390. You can consider that maybe a reaction. If we break it down, it got a nice little reaction from in front of the trend line. Again, that similar to the shooting star that we just spoke about, that this formed a bullish hammer, which is an opposing signal to the shooting star, and it indicates that sellers have exhausted and buyers have defended the support line and stepped back in, and the price has closed higher. Now, normally you would get a nice reaction off there. We got a nice reaction the following day, but then we had a number of indecisive looking days, which, although we maintain a short-term bullish outlook on this, only for the fact of a reaction. A break below the 1390 level and a close below 1390 would indicate that we have further to run on silver. So at the moment we're maybe trading within a range of 1390 to 1450. So from a short-term perspective, we're looking at selling around 1435 level, stop above 1450, and possibly buying around about $14 with a stop below 1390. The medium-term outlook is questionable on this. Not quite as convinced as we are on the gold, but at the same time, it doesn't look very pretty for silver. So we will remain bearish on the medium-term perspective. Now, if we look between the short and the medium term, so if we look between an intraday chart and a 3 to 4 week chart, we have this area around about 1450, that if we saw a break above 1450, we'd be questioning whether there's a turn in the market. A break and a close on a daily basis above 1450, we could quite easily see a reaction back to around about the $16 level. But in the meantime, we look to sell into rallies, looking for it to break this trend line here, and and go lower. Now targets, if we were forced to try and build a target for the silver, we can look to 1340 as the 127 extension. The better and bigger extension would be 161.8, which comes in at 1225. So, I mean, we could see, you know, I mean, that's the level we're looking for it to break. We're looking for it to break below this 1390 level. But be very, very quick to move if it breaks 1450. Some quick longs, looking to target just between $15.75 and $16. So a good move with it, and that would be classed as a very good risk reward trade because your stop would be below the 1390. So a little bit of a mixed bag in silver. Any questions, or anyone have any commodity markets they just want me to take a quick look at before I dive into the equities? The lack of response maybe indicates that you're happy with the way I'm going, or that no one's really listening. Let me have a look now at commodity markets. Sorry, equity markets. We'll look at the Dow to start with. I was tempted to look at DAX, which has been a very frustrating market from the bear perspective recently. But we look at Dow, and we look at the weekly chart in Dow, and we'll see obviously the bullish trend channel that has built up from 2009 lows. And it is a lovely channel. No, there's no denying it. It's firmly fixed in the bull camp. We had this wobble in August where the market looked to be turning, spiked below the bottom of the bullish trend channel, but managed to close the week. It managed to close the week above where it opened after a 1,200 point move. Or was it more than that? Yes, 1,400 point move. So that was a bullish hammer. Again, we just mentioned a bullish hammer. That led to a period of indecisiveness, but dips were continued to be bought before the week of October 5th, where prices eventually proved stronger. Buyers moved the market higher. We've yet to challenge the all-time highs, around about 18,365. Let me just bring the indicators in and give you this. This should give you a good idea of how the cloud can be of benefit. If we look at the channel, the cloud has sort of hugged this bottom of this upward trending channel until this year when we saw this big break. So that would have triggered some shorts on a more medium term basis, even a longer term basis. With a break of the 2014 fourth quarter low, 15,850, causing further stops to be activated. And prices, though, managed to regain ground and have consolidated in the cloud, which means that because we're still in the cloud, there's a likelihood of mixed and volatile markets ahead. And we we don't expect this to change anytime soon. We had a quiet week last week, obviously on the back of Thanksgiving. And if I break this down to the daily chart, we can see exactly what we've seen since the early November top. So another sell-off. Necessarily wasn't a big one, but it sort of like got to over 38% retracement, which is a good retracement, before buyers stepped in again. Now, the reaction higher has continued to store below 18,000. We're trading at 17,840 at the moment. Now, one thing I would look out for here is the fact that this is a reaction higher. So while we're trading on a weekly basis, we're trading inside the cloud, although it's quite close to the high. We've got to remain vigilant and not get carried away yet that this is going to extend towards the all-time highs. The prices seem to run out of steam, run out of bullish momentum last week, and have retraced slightly. But it's obviously, with the outlook for interest rates and with the US looking to hike rates, the rest of the world looking the other way, you're going to get disparities between all markets. And we want to remind you to keep outlooks separate, especially when you're looking at different regions and different stock markets. So what may apply for the Dow won't necessarily apply for the FTSE, or won't necessarily apply for the DAX, because the growth cycles in the economic business cycle may not be the same, may be different. But the one thing I'm keeping an eye on here, the US seems to be outperforming Europe and UK at the moment. Saying that, the fact that we haven't taken out November's highs keeps me a little bit defensive on this. We've got a small trend line here. It's not a very strong one. Better one would be drawn from there. So we will whip this one out. So there's a better trend line. Now, obviously, having a peak here and resistance, decent resistance around about the psychological 18,000 level. We're really looking at where this is going now, and while we remain we remain medium-term bullish on this, at the same time, things could change quite rapidly. So we would, with a bullish outlook, we'll be looking at maintaining a long position. Stop on this position would have to be below 17,000. That would be a clear break of this 16th November candle. Now, this 16th November candle could become quite significant. I'll draw a little horizontal line here to make it stand out. It was a previous resistance. We had a gap which was filled from August, that was filled here. Prices stayed around this level for a little while. So that shows you that buyers, sellers are both fighting for control. The revisit back to here on the 16th of November, buyers won the day. This formed, again, a bullish candle. Looks a little bit like a bullish Mariposa. Now, if we can manage to break above this 18,000 level, we expect price action to continue in an upward fashion, and would probably look for it to extend a similar basis to this. So what we're considering is the Elliott wave drive higher, wave 1, 2, 3, 4, 5. So that's what a break of 18,000. We're looking for 18,700. If you're not already long on Dow, maybe a good trade idea would be to be buying a break of 18,000. You can have a tight stop on this, maybe below 17,655. Remember, we're talking about medium-term bias, not a day trade. So you're looking at about a 350 pip risk on this, and you're looking to make 700 pips. So that would be a 2-to-1 risk-reward ratio for a medium-term trade. What I was trying to point out was the fact that if this fails and we do get a pullback, and the pullback does extend below the low of the 16th node, this formation would be called a double top formation. Double top formations are very good formations, very reliable, and they would look to, they'd give you a target as well on this formation, 1622. So again, I would say that with this cloud support, the chances of it are less likely than the continuation higher, but it's always good to be mindful of what else is going on and what places to watch, what levels to watch, because moves in the market nowadays tend to happen very, very quickly. So it's good to have all your information at hand to react quickly to the picture, as it's a liquid. Markets are very liquid and moving all the time, and being affected by a plethora of information from all over. So that's where we would look to this move to come back to 16,250 to 16,000. Again, stop on that would be like a monetary stop. So if we're looking at targeting a 750 tick move, our stop should be around about 50% of that. So we're always looks for at least 2-to-1. And I always believe that it's not necessarily how many percentage of winning trades are key. It's what the risk reward is in that winning trade scenario. So it's better to have, so for instance, if you have 2 or 3 trades that lose 100 points, and then you have 1 trade that makes 500 points, and effectively you've had 3 losing trades, 1 winning trade, but your P&L, if you've been disciplined, is far greater than you could ever wish it to be. So it is key not to focus too much on the number of winning, losing ideas, but actually look at the risk reward around those trade ideas. Well, that's Dow. We'll have a quick look at DAX. DAX again is at significant levels. We've seen the reaction high. This is the line chart going back to 2011. Some good points that it's reacted from. And 2015 has been a pretty busy year for the DAX. We saw a great rally, fantastic looking sell-off, and then the reaction higher again. We'll break it down to a daily chart, and we can pick out a few formations. This double bottom formation here from September got triggered October and gave a target of 11,700. The downtrend line capped prices and maybe looked for the market to turn around, but the cloud support came in. We've now seen the break higher. The break higher through the trend line resistance has come back to the trend line, tested it, and buyers have won the day again, and we're now extending higher. So we expect that the DAX is still in a corrective cycle higher. It's a long way in comparison from the all-time highs in comparison to the Dow. And this is where the geographical advantages, disadvantages are wrapped up into the analysis. So there's obviously a lot of QE going on. Europe looking to extend it, looking to maintain lower rates, and equity markets have taken this as a positive thing, which it is in the short term. I don't necessarily think it is in the long term. So we're looking at buying dips in the DAX. This would change with a break of 10,500. Our medium-term bias would become negative below there. But in the meantime, we're looking for prices to extend to 11,700. Possibly, let me see where we. 11,700, 750, and possibly up to the 12,000 level, where we saw the resistance after the peak or the all-time highs back in April. So short to medium term, we're looking at buying dips, keeping tight stops, looking for a break below 10,500 to signal a shift, a turnaround in this reaction, and targeting around about the 11,750 up to 12,000 levels. I'll have a quick look at FTSE. FTSE seems to be a different beast to other equity markets, and in my opinion, has been really underperforming the likes of the Dow and the DAX. We continue to. We'll look again at the long-term chart. And we see that the sideways consolidation over the last 2 or 3 years. And we look at this expanding wedge formation, which are notable and very difficult periods and areas to trade. So medium term, we've reacted off this just above 6,000, back up to just in front of 6,500. We'll bring the daily chart in to get a bit of a clearer picture, and we'll bring in the Fibonacci areas to show just how this has underperformed the DAX and the Dow. The sell-off from April, prices have only reacted to about 50% of the sell-off. So this remains pressured, FTSE remains pressured. We had again, this rally from the 16th of November hasn't quite managed to achieve the 6,500 level, which was the previous high. So although from a medium-term, short-term basis, we are looking again at being slightly positive on FTSE, we believe the resistance is likely to hold, as this is likely to be a leader in terms of when an equity market turnaround comes. There doesn't seem to be enough momentum, enough bullish interest to maintain the sort of gains. So that's pretty much covered the commodity markets that we focused on, and the major index markets. Before I sign off, has anyone got any questions? I mean, if you're interested in our analysis, that's available at the moment on a special deal. We're offering our service for free up until December the 18th, which is when we take our Christmas break. That's available at pia-first first.co.uk. I'll put that in the chat. The analysis is basically you register for the analysis, you make a monthly payment, the normal monthly payment, and we refund the money within a business day, so that you get the analysis up until the 8th of December for nothing. If you wish to carry on with the analysis, you find it of a benefit, then you don't have to do anything. If not, you just cancel the next subscription payment, and no further payments will be made. So I'll pop that into the chat. If there is any questions, fire away. If not, I'll look forward to seeing you probably in the new year, depending on whether we have a webinar on the 14th or not. So if not, I'll see you then. Have a good Christmas and a good New Year. Thanks very much.